Ever find yourself puzzled by financial statements? Well, you're not alone. These documents may seem daunting at first, but they're actually essential tools for understanding a company's financial health. Think of them as the company's financial mirror, reflecting its financial condition and performance. There are three main types of financial statements: the income statement, the balance sheet, and the cash flow statement. Each one offers a different perspective on a company's financial status. The income statement shows a company's revenues and expenses over a period of time, revealing its profitability. The balance sheet, on the other hand, provides a snapshot of a company's assets, liabilities, and shareholders' equity at a specific point in time. Lastly, the cash flow statement tracks the flow of cash in and out of the company, highlighting its ability to generate cash. Mastering these statements can provide a clear picture of a company's financial health. So let's dive in and demystify these financial mirrors, shall we? First off, the income statement, also known as the profit and loss statement. This financial report is like a company's report card, showing how much it's earned, spent, and ultimately how profitable it's been over a given period. Let's break it down. The top line, or revenues, is the total amount of money brought in from the company's main activities. From there, we subtract the cost of goods sold, which are the direct costs of producing the goods or services the company sells. This leaves us with the gross profit. Next, we deduct operating expenses, which are all the costs associated with running the business that aren't directly tied to producing the goods or services. Finally, we arrive at the bottom line, or net income. This is the final profit figure after all revenues and expenses have been accounted for. With the income statement, you can track a company's profitability over time, which is vital for any investor or stakeholder. Moving on to the balance sheet, a snapshot of a company's financial position at a specific point in time. This financial statement is like the photo album of a company's finances. It captures what a company owns, its assets, and what it owes, its liabilities. And not to forget the amount invested by shareholders, known as equity. Let's break it down further. Assets are categorized into current assets like cash and accounts receivable, which are expected to be converted into cash within 1 year, and fixed assets like property and equipment, which are used over a longer period. Liabilities, on the other hand, are the debts a company owes. These are split into current liabilities, debts due within a year, and long-term liabilities, debts due after a year. The difference between what a company owns and owes gives us the shareholders' equity, the net value of the company. The balance sheet gives you a comprehensive view of a company's financial position, enabling you to assess its liquidity and solvency. Finally, the cash flow statement, which reveals how a company handles its cash. This statement is a crucial part of a firm's financial reports, providing insight into its cash inflows and outflows over a given period. It essentially answers the question, where does the company's money come from? And where does it go? The cash flow statement is divided into 3 sections. Operating activities reflect the cash generated from the company's core business operations. Investing activities show the cash used or produced from the company's investments, like purchasing equipment or selling assets. Lastly, financing activities provide a snapshot of the cash from investors or banks and how it's paid back. Wrapping up, understanding financial statements allows you to make informed decisions about a company's financial performance and future outlook. Remember, the income statement shows profitability, the balance sheet displays financial position, and the cash flow statement reveals cash management.